Chapter 8, Part 1, we're going to look at flexible budgeting. Now, managers use budgets to control operations and see the planned objectives are met. And this is very important if you want your business to be successful. Now, a master budget is based on a predicted level of activity for the budget period. And the budget reports compare actual results to budgeted results. A fixed budget is a static budget. What it does is just looks at one level of sales, but it compares it to actuals, which may vary. A flexible budget or variable budget, what we do here is we do the budget based on different levels of activity. So when we compare actuals to the budget, we get a closer view of what actually has happened. So here is our example. We have a fixed budget, and what we budgeted was 1,200 units, but actual results are 1,400 units. So if we only compare this based on the fixed budget, we're going to ignore the units and just look at the sales, dollars, the variable cost, which is favorable because we sold more than we thought we were going to in sales. Our variable costs are unfavorable because they're higher than we expected. Now again, when we do these, just so you know on these charts, I don't know why they do it this way, but whenever you see variances, you don't show any, they're absolute numbers, which means there's no minus signs. You just have to remember that if in the example of variable costs, if your variable cost is higher, the actual is higher than what you budgeted, that's going to be unfavorable. Now, in this case, our contribution margin overall is favorable. We actually had a better return than we expected. Our fixed costs were also lower than we expected. So overall, we had a favorable variance of 50,000. But the truth is that really what happened? Because we also sold a different number of units. The budget is only based on 1,200 units, but we actually sold 1,400. So what's a flexible budget? Well, what we do with a flexible budget is we prepare it at different levels of activity. And it provides more what-ifs, best case and worst case scenarios. It provides an apples-to-apples comparison, and prepared after period ends helps evaluate performance. Managers can focus on the problems. So let's go ahead and flex our budget based on 800 units. If we'd only sold 800 units, we are predicting we would have had a loss. At 1,200 units, we should have had income of 91,000, and at 14,000 units, we should have had income of 127 based on flexing the budget. Now, when we flex the budget, if you'll notice here, we still have sales favorable, but not by as much. The variable costs are still unfavorable, but not as much. But the important thing is when we look at the bottom, we notice that our favorable is only 14,000. Now, if we compare this to our fixed budget, you'll see that it makes a big difference in our results when we do our budget comparison. So instead of 50,000 favorable, we still favorable, but it's only 14,000. So that's the reason we flex the budget, is because we really want to make sure we're making a good comparison in judging our performance. Now this ends part 1.